Hello, everyone, as you all join in. We're excited that you all are entering, and I know that it's still early. It's, right at the 12:01 time. So I'll let folks jump in. But as we are starting, we would love to know where you all are from and who is all here with us today. So first, locate that chat button you should see at the bottom of your screen, and change it to all panelists and attendees for us so everyone can see who's here. If you're a VCU graduate, please share with us your graduation year and which program did you graduate from. If you're a current student, do the same. Let us know when you're graduating and from what program. And if you are here just to support one or more of our panelists, you might be here to support Carolyn or Jeremy or Justin, or just to tune in on today's discussion. Let us know who you are too and where you're tuning in from. Thank you all so much. So yes, as you all come in, we'll get started shortly and let folks jump in. And if you've been, around for a little while we've been doing webinars, you know the drill. We just love to know who's all joining us today. So thank you all so much. Again, if you can change that to all panelists and attendees so we all know who's here with us today. So if you're just joining in and you're a VCU graduate, like I said, share with us your graduation year and where you graduated from, which program. If you're a current student, do the same. Let us know when you're graduating and from what program. And if you're, neither, and you just want to let us know, hey, I'm Letitia and I'm here. And I'm excited to be here. That would be great too. And let us know where you're tuning in from. I know that, of course, we have VCU alumni and students and friends of the university from everywhere. So let us know where you're tuning in from. So we have some Virginia Beach. Great, that is awesome. So I'm gonna go ahead and let us get started because I know that this is a much anticipated conversation. Everyone wants to know, how do we get started on this first time home buying? So welcome everyone to our first panel of the Adulting 101 series on first time home buying. My name is Letitia Taylor, and I'm the Director of Alumni Career and Personal Development with VCU Office of Alumni Relations. Before I turn it over to our wonderful moderator for today's conversation, I would like to go over just a few housekeeping points. So we will be recording this afternoon's event, so don't worry if you blinked a little too hard or missed a few seconds of the discussion, a recording will be available for you. There's also live closed captioning available that you should see at the bottom of your screen. But if you're having trouble with that, you want to access it, locate the live transcript button at the bottom of your screen, and once click select show subtitles from the menu. But if you're having any other issues with that, go ahead and message our VCU alumni chat bot that you should see in the chat. All right. So, and I would also like to thank those that were able to submit questions for our panelists while registering. We would try to get to as many questions submitted as possible. You all have some really great questions. Feel free to submit questions though via the Q&A pane of the control panel that you should also see at the bottom of your screen as we get through today's conversation. We will continue with questions that have been submitted during the event if time allows. So without further ado, I would now like to turn it over to our moderator, Carolyn McCray, Director of Financial Wellness with the Virginia Credit Union Financial Success Center at VCU. Carolyn, take it away.
Thank you, Letitia. We're so happy to be here. It is my great privilege to introduce all of you to our presenters this afternoon for our first time home buying webinar. We have, first and foremost, we have Jeremy Bowman. Jeremy is a Virginia native and a VCU alum where he majored in education, sports medicine, and athletic training with emphasis on physical therapy and pre-med. And I did see some of you had that physical therapy or pre-med that were joining us today, so you all have that in common. After graduating from VCU, Jeremy went on to pursue his career in healthcare for 11 years, during which time he was a personal trainer working with athletes from the pre-collegiate level through professional levels. Jeremy is a licensed real estate agent and has sold property in Richmond and the surrounding areas for over 7 years. And when Jeremy is not working, he enjoys traveling and great bourbon, enjoys exploring local restaurants and visiting new places, which of course Richmond is wonderful for new restaurants. And then Justin Friedrichs, who is our mortgage lender joining us today. Justin has been in the financial services industry since 1995. Prior to working with the mortgage lending, he was a financial advisor and planner until 2013 and made that career change to mortgage banking. He works with the group at Wells Fargo and maintains his certified financial planner certification. And he has been in mortgage lending for the past 8 years. Outside of work, he enjoys time with his children, running and paddling on the James River. So thank you both for joining us today. Thank you all for being here. We have set this webinar up into 3 different sections. Section 1 is going to be about what's involved with homeownership. Section 2 will be the process. And section 3 will be our section about getting under contract, getting you from contract to closing. So we've got some really robust information to give to you today. First, we want to get a little information from you. And so I'm going to launch a poll here just to get a sense of who is here. So we're asking for all of our guests here today, are you a current homeowner? And this is just to make sure that we are giving you the information that you need for the home buying process. Great, so we've got, perfect. Okay, so it looks like most of you had a chance to get in there. So Jeremy, Justin, we've got a couple folks who do currently own a home, but for far and away, 97% of those joining us today are not current homeowners. So that is fantastic. And so I will leave it to you all to take it away with our first section and tell us a little bit about what's involved in homeownership.
Hey guys, Jeremy here. Just want to say thanks for all of you dropping in today and taking your time at your lunch. I really appreciate it. I know Justin appreciates it as well. So yeah, that's great knowing who owns a home or who doesn't own a home currently. But yeah, what's involved in home ownership? Quite a bit of stuff. I mean, the biggest thing that most people take away from home ownership is that it's something that you own. It's yours. It's it's got equity. It's an asset. Things of that nature. But it's also something that you can use over time versus you're not having to move place to place and things of that nature. So homeownership comes with a lot of responsibilities, but it's also one of those things that's great to have. So Justin, what's your thoughts on that?
Yeah, you mentioned something really important, which is it's your house. So if you have a landlord that decides you don't have a landlord that might decide to sell the property and you've got to move whether you like it or not. That's a really important point that you raised. But the main thing is building the equity. Instead of taking money out of your pocket and putting it entirely in someone else's pocket, you're taking it out of your right pocket, and a lot of it is going right back into your left pocket in the forms of an asset that you're growing and building ownership in and tax deductions. So the only thing people just need to be aware of is when you're buying a home, you do have to take care of the maintenance. So that's the one drawback. Other than and pay utilities, most people have to pay utilities, but anyway, that's the one drawback of it. And over time, it's been shown, we can show you tables that show that building that equity over time is incredible, especially if you're putting, say, 5% down. You're putting 5% of a huge asset down. That asset's growing at 3% a year. Well, 3% on 5% is 60% return on investment. So it's pretty huge when you look at it that way.
Yeah, and I mean, another thing to take away with homeownership is, again, going back to the fact that it's yours. How many of you guys you're thinking about, oh, I gotta move in 3 months. I gotta move in a month. Where am I gonna live next? With homeownership, you don't have to think about that unless you're looking at maybe you all of a sudden have a family and you have a kid and you're looking at changing schools or potentially for your job and commute wise. So that's kind of the big advantages of having a home versus renting somewhere. You don't have to worry about that rent rate going up the next year. You don't have to worry about necessarily the landlord, like Justin mentioned, coming in and saying, hey, I don't want this house anymore. We're going to put it up for sale and it's time for you to find a new place to go. So there's lots of advantages to having a home. And again, going back, the big takeaways is it's yours, and you are building equity for the future. So you want to move on to the next question?
We've gotten a couple questions in from our guests here today. And gentlemen, you touched on this a little bit, but we did get a question about what would you say is the real cost of owning a home when you're thinking about that step into home ownership?
That's a very good question. It just really all depends what you're trying to get out of your house. You have some people that they go in and they want to, make it to the nines, dress it to the nines, and they're going to come in and just paint it and redecorate it and all this type of stuff. And then you have others that just want to keep it simple and they want to make it theirs, but they don't want to have to deal with, again, having a landlord telling them what to do or this and that. So it ultimately comes down to what you're trying to get out of it. Is it something that you're looking at long term, or is it something you're looking at short term? Going back to what Justin kind of mentioned about with the rental aspect, is that's money that's never coming back to you. You're giving that money to somebody else, and right there alone, that's a cost of renting. Again, when the cost of homeownership, you have to take that stuff into consideration, is that, yeah, you're paying something out of pocket, but you're putting it right back into your other pocket for down the road, basically. Other things that go into the cost of owning a home, maintenance repairs. Again, when you rent, you may not be responsible for those repairs. But again, most repairs are far and few in that sense. You're not doing them every day. You're not doing them every month. You got a couple big repairs that come up occasionally, once every 5 years, every 10 years, every 20 years kind of things. But those are all things that you have to take into consideration, and those also affect your equity. Again, so the cost of owning a home really comes down to what you are ultimately trying to get out of it.
I think it's a good answer to run with. What's the next question?
Great. Yeah, we're getting quite a few questions coming in, and I definitely recommend to our guests, if you have a specific question for Jeremy and Justin, please use that Q&A feature because you can send your questions in to us. Have another question that has come through, and this might lead into our discussion about the process. But we had quite a few questions about how do you determine your budget for buying a house, buying furnishings, moving expenses, and also how soon should you start the home buying process?
Definitely. We're going to go into definitely some of those questions in the process, but just a quick, touch on that, and I'll let Justin touch on afterwards. When you go to rent an apartment, you're going to have to buy that same furniture. So it's the same concept when you're buying a house. So those are one of those things that if you're going to spend, $1,000 on a bed set, a bedroom set or whatever, then you're probably going to spend that same amount when you buy the house. It's just a matter of, does it fit that room versus the apartment room? Yes, you may have to buy some extra furnishings because maybe you have a 3-bedroom house versus a 1-bedroom apartment, things of that nature. And again, there are, as we mentioned, repairs. Those are things that you have to budget on. But again, we'll go into that a little later, but Justin, I'll let you answer that question as well if you got any insight on that.
Sure. As far as what you need to get prepared for, and we're pretty much going to go into that next segment about the process. What you should be ready to do. Generally, the minimum down payment for a home is 3% nationally. There are some programs out there that you can find where you can put as little as 0 down. They're getting fewer and farther between. But they're out there, and we can certainly send you in that right direction. So I would say if you've got a purchase price in mind, if you are looking around and you you've got a great realtor like Jeremy sending you, set you up with a link that basically updates you on a daily basis of what is new with your parameters. And you find that, say, $200,000 is, that's a livable, lifestyle. You find that those fit your needs. Then I would think that you would need about $6,000 for that $200,000 house, plus something called closing costs and escrows, which we'll get into in a little bit. But just to answer that question, that's pretty much where we are as far as what financially you need to prepare to do. I would say about 3% down payment, plus closing costs and escrows, and we'll get into that in just a little bit. So do we want to ask that next polling question now?
Sure can. So for all of our attendees, we have another poll for you. And as we get into the part of the home buying process, we want to know if you've got a friend or family member who is an agent who could help you with the home buying process. So you'll see that poll up on your screen right now. And we'll just take a couple seconds to give everybody a moment. Jeremy, Justin, I think those were some really great answers to some of these initial questions. And we're seeing a lot more questions coming in about how individuals can qualify, how they can negotiate. And so I'm really excited to talk through this part with you.
Yeah, exactly. And everybody's situation is individualized and different. So sometimes these answers seem like they're very vague and generalized. It's not to scare you off. A lot of times we have to dig a little deeper to figure out exactly what the individual is looking for and what they have and what they don't have. So again, as a first-time home buyer, we're trying to give more of an overview of everything and not just, dive in super deep. That's something we can do on an individual basis.
Thank you. And thanks to everybody for taking some time to answer this poll question for us. So we've got a pretty even split. Some folks have got somebody who's in the know, and another half do not when it comes to the home buying process. So thank you all for taking the time there. So Justin, Jeremy, if you could tell us a little bit about the process.
Sure. Yeah, the process is, I think, I like to say the easiest thing to do as far as the process is to qualify for a mortgage. Getting a mortgage and getting pre-approved is another thing, but your general, day-to-day behavior, paying your bills, that's the most important thing to lead up to this. Make all of your payments on time. If you don't, your credit score is going to be lower. It's going to adversely impact your rate and your closing costs, believe it or not. So I would say before you even get into the process, you want to be just behaving as you should with regard to your current liabilities. Because what the process does is it goes through a pre-approval. The first thing you got to do is get a realtor and get a lender. And the realtor will probably say, I'm excited to work with you. Can you please talk to Justin or some other lender and get pre-approved? And the pre-approval process involves looking at what you have to put towards the transaction, what you are earning right now, so that speaks to your ability to repay a mortgage, and your credit report, which ironically speaks to your willingness to repay previous debts. So, those are the three important things we look at. And that's why I stress that no matter what you're doing, make that minimum payment on a credit card. Because if you go late, it really hurts your score and adversely impacts your situation. However, once you've identified the assets that you'll use towards closing, be aware that qualified assets for purchasing a home include your own money that you've already got, obviously. You can also use gifts from family members. Can't be from a friend, got to be from a family member. And you can also use secured loans. So what's a secured loan? A secured loan is a loan backed by something you already own. So if you have a stock account, you can do a loan against that and use that as your down payment. More commonly used though, is if you have a 401k. People don't realize that most, if not all 401ks, offer a home buyer loan program where you can borrow up to 50% of your 401k or $50,000, usually whichever is less. and you can use that as your down payment money and closing costs. The nice thing about that, if you really need it, I don't suggest you do that up front. I'd rather, obviously, you save it, maybe get a gift, nudge some people. But if you end up using the 401k, you're just borrowing from yourself and paying yourself back. It doesn't ding your credit report or anything like that. It's pretty straightforward. So once you figure out what you have to put towards the transaction, and your lender will help you with that, I'll help you with that. Then we help kind of figure out what your monthly payment is that you're willing to pay. So when you're getting ready to talk to the lender, you might kind of get in your head, and a lot of people look at it relative to their current rent because that's all they know. So if you're already paying $1,300 a month, is that really, really comfortable for you, or is that really a stretch for you, or is it just right? And then you would kind of convey that information to your lender, and he or she will try to plug in, exactly what's going to work for you in terms of purchase price. So that's basically what goes into it. Find a realtor, find a lender, and you have to get pre-approved. So what is the pre-approval letter? The pre-approval letter is basically a letter that says, hey, we have looked at this individual in terms of giving them a loan to buy a house. We've determined that they have the sufficient assets for the down payment requirement and proper credit and past payment history that we are willing to lend them the rest. So let's say the scenario we talked about earlier, 3% down. So we verify that they have the 3%, and we're willing to lend them the other 97%. That's what the pre-approval letter basically says. Now, why is this important? If you're in today's market, as you may be aware, it's a very, very hot seller's market, meaning there are multiple buyers for every property up for sale right now. So it's now become a standard. The only way that a seller is going to want to accept your offer is if they are assured that you will be able to come through with the funds. And the only way they know that is if you have the pre-approval letter. So this is really the main ticket to getting started to house hunting. You've got to have that. No seller today, and probably for a long time in the future, will accept a contract unless it's got a pre-approval letter with it. So that's the main and important piece. I'm also going to go into briefly, we can answer questions in a sec, but I want to go into briefly just what is included when we're talking about qualifying you for that payment. What we're looking at is how much of a burden is this payment going to be relative to your income? So this is called the debt to income ratio, or DTI as we call it. So what we do is we take the proposed housing payment, we add to that your other current monthly payments. That would include student loans, car payments, minimum credit card payments. We add all those up, and then we take that number and divide it by your gross monthly income, pre-tax, so the big number, which is good. And that ratio generally can't be more than 45%. So keep that in mind. So when you're looking at your current situation, take your car payment, any other payments, and then let's say you think your home payment is going to be maybe $1,500 a month. By the way, $1,500 a month, if you're paying rent right now, $1,500 a month can buy you a $280,000 house. Something to think about. So let's say it's $1,500 a month and you have a $300 car payment and $200 in student loans. That's $2,000. You divide that by your income, and if that ratio is 45% or less, you're going to be in very good shape to qualify. And the monthly payment that we quote for a house purchase includes the loan repayment, and also we collect every month for your taxes and insurance. So unlike your car tax, where you have to kind of come up with the money once a year, we collect that for you every month so that there's no surprise. And insurance, what do I mean by that? Well, if you own a home, we get something called hazard insurance, which protects the property, i.e. the collateral for the lender, from fire or any other kind of damage that might happen. So hopefully that's helpful. Do we want to go to Jeremy? Do you have any other thoughts on that?
No, I mean, for the most part, the biggest thing is that's the beginning of the process. We highly suggest and recommend that you definitely always get with a lender first, because there's no point in going to look at a house if you don't know what you can afford. We get a lot of people that just want to go kick the tires, as they say, and they want to go look at a home and it's 400,000 and they can really only afford a $250,000 house. They get their sights set on that house and then they go get with the lender and that bubble's bursted. So it's better to go ahead and know exactly what you can afford. And that way we get you into the proper bracket of what you're looking for from the get-go. So definitely that's the first portion of the process. So I know there's quite a few questions that have been coming in. Do we want to knock a couple of those out?
Very popular topic. Yes. Yeah. Very popular topic here. Justin, I think several of these questions refer back to that debt to income ratio that you were just talking about. So want to make sure that everybody's getting the information that they are looking for. So we had some questions about, what kind of impact do student loans have on approval? And really that comes down to that debt to income ratio. Excellent. We also had questions about credit affecting home buying, which you had touched on initially. Can you buy a house with bad credit? What would you consider to be a good credit score to pre-qualify for a mortgage? Our folks who are tuning in are wanting to know. And they're also wanting to know if, with that debt to income ratio, if you can buy a house when you are maybe in graduate school and not necessarily working full time.
Okay, good questions. I'm going to start with the student loans. That's an important question because a lot are in deferment just automatically due to COVID-19, which is nice. So this is important. I'm really glad whoever asked that question. Student loans usually have a minimum payment. They don't right now, they're being deferred. But we usually go with the payment on the credit report. If there's no payment or if it's deferred, even if it is deferred and you're not obligated to pay it, we still have to plan ahead for the fact that you will be obligated at some point. So the rule in our industry is we take 1/2 of 1% of the balance. So take 1% of the balance, cut that in half, and that is the monthly payment we have to charge against you, even if you're not paying it. So keep that in mind when you're computing your DTI. It's a really good question. The credit score question, generally speaking, the minimum in our industry is around 620. You'll find some other lenders that'll do 600 or even 580, but I think you'll find that the rates and the terms get to be really kind of icky, So I think your main goal should be to have a 620 or better credit score. Obviously, the higher the better, but that's generally the answer to that. And I want to keep us moving because I'm watching our time. We have a little more to go. But was there a third piece, a student loans, credit score?
We have the student loans, the credit score, and could you pre-qualify if you aren't working full time, if you're a graduate student?
Absolutely. Yeah. If you're a grad student, you can, but you've got to have the income. So if you don't have provable income, you can't qualify. So if you got a full-time job as well as being a grad student, then that is usable money if it's full-time and if the employer will verify that. If you have a part-time job, this is very important. A part-time job must be in place for 2 years before we can use it, just to let you know. So it's got to either be full-time employment or part-time more than 2 years. Okay.
Perfect. Thank you so much. So let's move on to we have quite a few more questions, and folks, we'll try to get to all of them for each of you. And we will be providing some additional contact information if you want to follow up with any of our panelists who are on the webinar today. But our next question, before we get into the getting you from contracts to closing section, so if you would chat your response, because this is an open-ended question. So if everyone would kind of chat their thoughts, what are your expectations of a realtor? Love to see those. If you just chat those to the panelists, we can kind of take a look at what are your expectations of a realtor? All right, show houses, help me make a good offer. Have the buyer's best interests in mind. Excellent. So we're seeing a lot about knowledgeable about the area in which you're wanting to buy, with that showing houses, kind of knowing the market, knowing the entire process, being a guide. Industry expert. Sounds like industry expert, gentlemen, seems to be the big part for our first time home buyers, right? Because this is a new process if you're buying for the first time. Keeping it real. I like that. Yeah. Open and honest communication. And being patient, right? Home buyers are picky. Yeah. Kayla, that's not just you. I think that's anybody when they're buying a house. Yeah. Awesome. Those were great. If you've got additional thoughts about what you expect from a realtor, feel free to continue chatting those in, and feel free to use the Q&A function to continue submitting some questions. We'll try to get to all of them. But Jeremy, Justin, I'll turn it over to you to talk about the process from getting us from contract to closing.
Yeah, awesome. So we just went through the process basically of getting you started. That's by basically getting you qualified, pre-approved. So Caroline, if you don't mind popping up that one screen that we talked about earlier, just so I can kind of start that off. Guys, I want to show you this graph, basically the last 12 months, what's going on in the market right now. So what you'll see right now is you see listings available over the last 12 months, and that's broken up into each month. In February of 2020, so over a year ago, basically pre-COVID, we had almost 3,500 houses on the market for the month of February. And you can see going into March and April, it stayed above 3,000 homes on the market. Now let's go all the way to February 2021. We have less than 1,500 houses on the market currently. And if you want to look at a full month of January, we have less than 2,000 houses. So that's over 1,500 houses that we had less than compared to last year. That's massive. So I've seen some questions about the market and things going on and the challenges. So this is definitely one of the biggest challenges that you're going to face as a first-time home buyer. And this is why it's important to have good expectations from a realtor and knowing what you want, and also having the realtor that's going to listen and help walk you through the process. It can be very tedious. It can be very daunting. It can even make you, just feel like you're failing over and over and over. Right now, on average, if the house is under $350,000, which is what most first-time home buyers are looking at, in a price range probably of $150,000 to $250,000, you're going to have anywhere between 6 and 50 offers. Now, I know that's a really wide range, but it also depends on the area. If you're in really hot areas like Richmond proper, Henrico, Weston, Easton, Northside, Chesterfield, I'm seeing upwards of 50 offers coming on properties, competition wise with my own buyers. So it's definitely, you got to be prepared, and you got to understand, which is, again, goes back to the whole reason why we want to get you with a lender first, so that we can get you best prepared to make that offer and the challenges that may come up during that entire process. So hopefully that helps a little bit, understanding what's going on in the market, and that, when we're saying that this is a seller's market, that we're not just saying this just to say it to try to get you to make a higher offer. We're saying this because essentially the sellers have the control in the market at the moment. So let's get into a little bit of going, getting you under contract and going through the entire process. So you've gotten with Justin, or you've gotten with another lender, you know how much you're qualified for. So the next step is essentially we start sending you homes. You're starting to look at homes on different sites, my site, Zillow, Redfin, Realtor.com, wherever that you feel most comfortable looking. And you come across some homes. Okay, so what we're going to do next is we're going to go look at them either at an open house, or we're going to schedule some private showings, and we're going to do a walk through the house. Now, the biggest thing you can do is you can go drive by the house at the beginning before we even go look at it if possible, because if you don't like the outside of the house, you're not going to probably want to be in that house. So that helps in making sure that we're not just going to look at something just to look at it. Okay. So let's say that we've gone and found your perfect house, okay? We're gonna make an offer. Now, there's a lot more that we can get in depth in, and I know there's gonna be lots and lots of questions about that, about how to get the best deal or things of that nature. Those are questions that we can answer individually because, again, everybody has different priorities and different expectations on what they want deal-wise, or maybe they have more money to put down or things of that nature. So we're just going to kind of walk through the whole process in a general basis, though. So we're going to make an offer, okay? In that offer, we're going to have a couple major points. We're going to have a purchase price. We're going to have an earnest money deposit amount. We're going to have a home inspection period time. We're going to have a contingency on appraisal. We're going to have a closing date. And then we're going to have any other additional terms. So maybe we know that the seller wants to rent the house back for a period of time, and so we might add that in because you're renting an apartment and they're looking to buy their house, and clearly, as we've shown, the market's crazy. Or maybe you want the mirror that is in the half bath to convey with the property, things of that nature. So we can add additional terms in there. So that's the main part is the contract itself. So we make the offer, we write the contract up, we send it out over to the seller after you've signed it. And from there, the seller is going to end up doing one of three things. They're going to accept the offer as is, which, yay, that's the best news that you can get. The second one they're going to do is they're going to negotiate with you, which means that they're going to counter offer. They're going to come back with maybe an increase in price, or maybe a change in date, or a change in closing costs if you're asking for closing costs, or maybe ask for a higher earnest money deposit, things of that nature. And that's the second best option you can have. So that's the negotiation aspect, and that can go back and forth until there's a meeting of the parties, or we move into the third part, which is basically all sides decide that they no longer want to negotiate this out or just can't come to a meeting of minds. So basically both parties walk away and nothing continues from that point on. So let's say that we've gotten your house under contract. The sellers agree to what you've offered. You're excited, you're happy. We got to hold on though. The process isn't done. You don't have the house yet. The next process is basically we are going to go and do a home inspection. In Virginia is a buyer beware state. What that basically means is a full scale thought process is it is your responsibility as the buyer to do your due diligence. It's not the lender's responsibility. It's not the seller's responsibility. It's not the listing agent's responsibility. It's not an attorney's responsibility. It's not the realtor's responsibility that's helping you buy the house. It is your responsibility to do that due diligence. So how can you do that due diligence? Well, we have that home inspection period. That is where you go out and you hire a home inspector. That home inspector for a fee will come in and they are going to do a thorough overview of the house. They're not going to move stuff. They're not going to tear walls apart, anything of that, but they're going to do a visual inspection of the house and anything that's above or below the house, inside and outside of the house. Okay. Doesn't mean that the house is, going to be perfect. Doesn't mean that the house is going to be, oh my gosh, walk away kind of situation. But what it does is it tells you what is going on with the house and what you're getting into. And from there, we can move into how to negotiate the next step. That may be that we ask for repairs. It may be that we ask for a credit because maybe you're really handy in the simple things that you're like, oh, I was going to plan on taking that wall out already and put something else in, or I was going to paint that, so I'm not worried about this, or any of that type of stuff. There's a lot to it, definitely, and every house is going to have its issues or not issues that you feel is an issue or not an issue. The biggest takeaway is that in Virginia, it's mechanical and safety issues. It's not cosmetic issues. So if you don't like the paint in that room, it's not something we can go in and say, hey, seller, can you fix this? But if, let's say that the heat pump isn't working properly, we can go back as a negotiation aspect and say, hey, we would like the heat pump to be serviced and or fixed. So that's called the inspection period. Okay. within that same time period, we're also going to have what's called an earnest money deposit. That's basically, think of it as your security deposit for a rental property, a property that you're renting, or an apartment complex, okay? You are putting that money down in good faith that you are going to close on this house. That money does go towards your entire overall picture of your closing costs. So it's not like you're putting that money down and you're never going to see it again. You will get to see that money again. So that during that same time period, you're going to be getting that money over to an attorney. Okay, so we are going to be working with an attorney or a closing agent who is going to do all the title work. They are going to basically, in conjunction working with the lender and me and you, they're going to make sure that the house doesn't have any liens, doesn't have any issues, or any outstanding things that, you know, we may not know, kind of thing. They're also going to provide the potential to have title insurance, which protects you once you do close on the house from having somebody who maybe did work on the house prior to you owning it coming and saying, hey, you owe me $10,000 for this work I did. So it's very important to understand that aspect. Not everybody gets title insurance, but it's part of the process, and it's a good thing to know when an attorney is talking to you and or the lender's talking to you about that. So we've done the earnest money deposit. We've gone through the home inspection. The next process is going to be basically you're going to go into your appraisal. Okay, that's where you get to have fun and you get to talk to the lender again. You don't really get to talk to me too much as your realtor, but I'm always there to help crunch the numbers and help you understand it. But the lender is going to basically have to make sure that the property value of which you are paying is matches up or is or meets their expectations to what the actual value of the property is worth. So that is the difference between an appraisal and an inspection. Inspection is determining, you know, if there's any issues with the property, and appraisal is determining what the value of the property is for the bank. There usually is a fee involved with that. It varies, but typically it ranges right around $500. I'm sure Justin can correct me if I'm wrong on that in terms of that. But that is an out-of-pocket expense that you will have. We've gone over the home inspection, which ranges about $500. Now we've gone over the earnest money deposit, which can be a minimum of $500 to upwards of 1% of your purchase price. And we have the appraisal. So you will have 3 out-of-pocket expenditures during this entire process. This process will take anywhere from 30 to 45 days on average. Each one kind of moving along the milestones. So to just kind of go back one more time, you have your earnest money deposit, which happens within the first 3 to 5 days. You have your home inspection, which happens in the next 10 to 14 days. Then you have your appraisal, which is going to occur typically within 14 to about 20 days. It just depends on how quickly the appraisal is ordered and you can get the appraiser out there. At that point, the lender is going to get with you and say, hey, look, you've met your value on the property, or hey, the value is not there. We need to talk about this and see what you want to do. To not get too deep into that, but if it does come under value, there's a couple different processes within that. You can negotiate it with the seller. You can pay the difference either by negotiating with the seller and splitting costs, or paying it yourself. Or at that point, you can walk away and you get your earnest money deposit back. So, you know, that's a protection when you think about it in terms of what the appraisal is there for. We don't want you to get, you know, especially with this market, people are offering more on a house than what it's maybe worth. We don't want you getting in over your head just because, you know, the market's saying it's worth this, but the reality it's not. Because even us as realtors, even though we run those numbers, we may not get it correct all the time because the appraisers are held to a different standard of what they look at and what they don't look at. So we make it through the appraisal. Yay, everybody's happy. Numbers meet. We're not quite there at the end of the finish line yet. The seller now has the responsibility to do a termite inspection, which is great because you want to make sure that you don't have any wood-eating insects coming in and destroying your foundation or being inside your walls or things of that nature. So that is the seller's responsibility. If they are on a well or septic, it is their responsibility at that time to do the inspection as well for their property. Okay, so those happen typically after, the appraisal, right around the appraisal happens. And the reason why is because sellers like to hold off onto that, because if they don't, if we don't get past that appraisal, then they're not going to spend that money to do those inspections that they don't need to yet. During that time period, you're going to get back with the lender. You're going to get with the attorney for some final document stuff. You're going to start hearing the word CD or closing disclosure pop up quite a bit. Your life is going to become tied to the computer and essentially signing these documents over and over every time there's an update. But that just means you're one step closer. As I mentioned at the beginning, we have a closing date. So that's where we would move to next. You've gotten with the lender, you've gotten with the attorney, we've made it through the inspection, the appraisal. Now we're going to go ahead and schedule that closing date. And that's the most exciting part, because that means that you are going to be getting the keys to your brand new house, or to you brand new house if it's not a brand new build house. So usually on average, that takes 30 to 45 minutes, at least upwards of an hour, depending on the type of loan you have. So that's something that you have to set aside for when you're thinking about when you want to do the closing. A lot of people, we work 9 to 5. Closing agents work 9 to 5. So you got to take time off and you got to figure out your schedule and getting that done. And that's when you can start scheduling movers and things of that nature to come in. That's when you can go back into about furnishings. That's when you can start looking at furnishings and expenditures of that nature. We usually tell people to try to hold off during the process and throughout the contract from making any unneeded expenditures like washer, dryer, kitchen sets, bedroom sets, things of that nature, because that can affect your loan. It can affect your debt to income ratio, especially if you're pulling them out and putting them on that 0% interest credit card that Lowe's decides to offer or something of that nature. But we made it to the closing table. You're going to sign your life away for the next 10, 15, 30 years. You're gonna, the attorney is gonna go over everything with you. And at that point, we hand you the keys and the house is yours. Now in Virginia, there is what's called possession at settlement and possession at recording. So typically in Virginia, you will get the keys at settlement. However, there can be the particular situation where you may not be able to have access to the property until recordation, which in that terms means that the attorney would have to let you know when you can get into the property. But 9 times out of 10, you're going to be able to access that property once you've signed all the paperwork. So I know that was a lot to go over in a very short period of time, but that's essentially getting you under contract and getting you to the closing table and handing you the keys to your brand new house. Definitely, if you have more questions in depth or you want to know a little bit more about parts of the contract, feel free to definitely reach out and we can definitely go over that.
I think that was just a wonderful showcase of why we have Jeremys and Justins in the world to help us through what is a very complicated process. So thank you for such a wonderful overview. We're going to take the next couple of minutes just to answer a few more questions that are coming through. And then we will be providing contact information. If you have more specific questions for Jeremy or Justin, or you would like to get involved with the Financial Success Center here at VCU for free financial coaching to figure out how you can afford that first house, we'll have all of that contact information here available for you in a few minutes. One of the questions that just came through, gentlemen, is the transition from being in a rental to moving into that house, getting through that closing process. When you're saying that Richmond is a very complicated market right now, there's a lot of competition. So if you've got to break a lease, what are your recommendations for moving from that being in a lease, being in that kind of contractual obligation to actually owning a home?
Yeah, so believe it or not, if you're renting currently, you're probably in the best position to go out and purchase a home. You don't have to worry about getting your house up for sale, getting your house under contract, making sure you have the funds clear to close on that house to make sure you can close on your new house. So typically what I suggest with people that are renting and they're thinking about buying a house is, like I said, it takes 30 to 45 days to close on a house. So I always like to err on that side of 45 days just because things can come up, and it never hurts to have a couple days a week overlapping from the time your lease runs out to moving into the new house, because that can let you go in and kind of clean the house a little bit more, or move things in slowly and kind of arrange things within the house yourself. So in some ways you are actually set up better in terms of the competition aspect. And I briefly mentioned this way back in the beginning. There are things that we call seller rent backs. So essentially the seller rent backs the house from you for a period of time. So that can be used towards your advantage in the negotiation aspect. So let's say you have 6 months left on your lease. We start looking for a house. Oh my gosh, you found your house in the first month, because just happened to be that was your house. Well, we could set a closing for 60 days out. So now we've eaten up 3 months of your time. You still have 3 months left on your lease though. What am I going to do? You can do one of two things. You can break your lease, which is going to cost you more money. Sometimes you can get the seller to pay those. But with the way the market's moving right now, maybe that seller needs 60 days to buy a house and close on a house. So now we could do a 60-day rent back from the seller, and essentially they're paying you to live in your house. And now you've eaten up 2 more months of your lease, and now you only have 1 month of a transition between your rental property and your new house. Now, it's not what I always advise, because that's scary having somebody else rent from you, especially when you're doing it short term and you're not a landlord. But again, there's different documents that are involved. There's monies that we put on paper that's involved, that they're going to pay you up front. They're going to pay you basically per a day, and then X amount of dollars beyond the agreed on date, that we make it really difficult for them, to make them basically push their buttons to make them want to move out. If you think about it, you go and you rent a hotel, you're paying $50 to $100 a night kind of thing. You may charge this person for the first 2 months what you're paying on your mortgage. Okay, so if your mortgage is $1,500 a month, they're going to pay your mortgage for you for your first 2 months. But after that, we don't want them to take up every day of basically staying as long as they can and eating away into your time to have to move in. So now we might make it, $500 a day that they have to stay there. Okay. That adds up real fast when you think about it. All of a sudden you take 30 days at $500 a day. That's a lot versus that $1,500 a month of your mortgage. So there's ways to protect you on that. So definitely great question. But I always say people that are renting, they're definitely in a market as this, they are in a much better position.
Thank you, Jeremy. Justin, I think we've got time for one more question, and we have gotten quite a few questions that I think are directed specifically to you, and that is about the loans and grants that are available for people to use. We've had questions about, are there grants for first-time home buyers? Do you have preferences between a standard loan or a physician loan is one question that we got, and then also, how might a person be able to use an FHA loan? You wouldn't mind talking about that a little bit.
Sure. So there are a lot of grant programs out there. I'll just break them down really quickly. There's one called HOME. It's an acronym: Housing Opportunities Made Equal. If you Google that, go to their website, you can apply for a grant there. I feel like Karen might have some familiarity with that group. And Carolyn. And then there's, if you are a sort of a civic employee, so a teacher, firefighter, police officer, there are grants available for those folks through the Federal Home Loan Bank of Atlanta. Federal Home Loan Bank of Atlanta. But you don't have to go to that bank to get your mortgage. There are lots of mortgage lenders in Richmond that offer through those grants as well. One of the easiest, most prominent ones in Virginia is the VHDA, Virginia Housing Development Authority. They offer the easiest grant. All you have to do is be under a certain income limit and have a certain credit score, and you can get it. You don't have to fill out a big package and wait for time to get approval. It's almost automatic as long as they still have funding. So, and there are lenders in town that offer that. As far as the next question, I feel like there was another question about, what was the last part?
There were questions about specific loans that are available. So we
Yeah,
had,
okay,
we had
FHA.
them in- yes, yes.
Yep, sorry. Yeah, so generally, if someone has a credit score over, I would say, well, we actually do mainly conventional loans all the way down to 620. And we find that people are financially better off than FHA doing that. However, most other lenders might encourage FHA. Some key points to be aware of. There's something called mortgage insurance. If you don't put down 20% as a down payment, less than 20% down, you'll be required to pay mortgage insurance. FHA, their mortgage insurance is permanent, meaning it never, ever goes away. You have to refinance the loan or sell the house for it to go away. The conventional loan, though, you start with that mortgage insurance payment. It's attached to your mortgage payment. It's a small amount attached to your payment. But once you get to 20% down, it goes away. So it's one reason I prefer conventional. Another is FHA has a funding fee upfront as well for the mortgage insurance that's added to your loan amount. So with an FHA loan, you might walk in the door with 1.75% equity, meaning you're really borrowing 98.25% of the value. Whereas with that conventional loan, you're still walking in the door with 3% equity. You're still just borrowing 97%. I know I went through that really fast. I'm just looking at the time, so I don't want to do that too quickly, but I'd be happy to explain in detail if anybody wants to call me or text me later.
Great. Yes, we are right up on time. So Justin, Jeremy, I want to say thank you for taking the time to be with us today. I know we didn't get to all of your questions. We will have opportunities for follow-up with both Justin and Jeremy, or Alumni Relations, or the Financial Success Center. So just want to say thank you all so much for joining us today. I'm going to turn it back over to Letitia to send us on home.
Yes, thank you, Carolyn, for moderating today's conversation, and to Jeremy and Justin for your knowledge and expertise on the home buying process. It can be daunting, but you all made it so simple and easy. So thank you so much for that. If you enjoyed today's conversation, we encourage you to register for our upcoming panels this month in the Adulting 101 series that you will now see linked in the chat. Our next one is the psychology of spending. So that'll be very interesting to get some information on that. Lastly, everyone should also see a link to a short survey to complete so that we can get feedback and thoughts on today's event and how we can best shape our upcoming events. If you aren't able to grab that link before we end today, it's okay. We'll also be sending it out via email with the recording of today's event. On behalf of VCU Office of Alumni Relations, also the VCU Alumni Recent Graduate Council, and Virginia Credit Union Financial Success Center at VCU, thank you for joining us today, and have a great rest of your day.